You're listening to the greatest multifamily investment advice show. My name is Adam Ras, and now I'm talking everything multifamily for an in-depth conversation, and I will be diving deep into raising capital, deals, and underwriting process. Welcome back to the greatest multifamily advice show. Today we have Bronson, real estate syndicator from Los Angeles with more than 17 years in real estate investing. Please help me to welcome our guest today. How are you?
Good. I'm really glad to be here. I love talking about real estate and multifamily and just, there's a lot of changes, a lot of things happening today. So I love talking about all that and how people can get started and get moving and obviously grow their wealth.
Especially yesterday, I think the Fed's already, as expected, 20 PPS point, and hopefully we can have slow down on the interest rate on the next 4 or 5 months, but we'll see.
Yeah, that's really kind of the big thing right now with the Fed is that it's really driving everything, right? So we're basically kind of watching the Fed, and a lot of lenders now. Lending is really the hardest thing to navigate right now in any real estate because rates are continually rising. And so once rates actually kind of stop rising, they start, okay, there's kind of a trend of either things holding or starting to come down. I think lending will really open up a lot. There'll be a lot more lenders that want to lend.
So before we start to syndication, I want to start usually with the beginning for my guests. And why commercial real estate? What bring you into the field? So what was the beginning for you?
Yeah, so for me, I was a high-paid medical sales professional. I was making over $200,000 a year, selling surgical equipment in the OR and different surgical areas. I'd worked with a lot of physicians. Obviously, they were very high net worth, and I had a couple of physicians I worked with that they made over $2 million a year each, but they were working 70, 80 hours a week. And I just thought, that's not really financial freedom, right? If you have a lot of money, but you have to work all the time. And so Warren Buffett has a saying that, unless you learn how to make money while you sleep, you will work until you die, right? So for me, I kind of I thought about that. I was like, well, what can I do that actually generates more capital? And so I had been doing some real estate, but I discovered multifamily, and I just realized I could use it does take money to make money, but it doesn't have to be my money. It could be other people's money, and I could go after and do a big apartment deal. So the idea of getting cash flow, getting income that you didn't necessarily have to work for. Obviously, when you're passive, the mailbox money, it shows up every month or every quarter, which is awesome. So that's what I'm really committed to helping people do.
So before the show, we talked about you starting on every syndicators as a first step on single family home and duplexes and small multifamily, and then jumping to syndication. But you had this an actual example of not investing on fringe market. You're from Los Angeles, but actually spending on, or you're investing on the Sunbelt basically. So tell us, what was the actual reasoning driving you to the Sunbelt?
Yeah, so in California, we just kind of find the most common sense way of doing everything, and then we just do the exact opposite. And so it's a little hard when it comes to investing because, if you're a landlord, you have very little landlord rights. If somebody doesn't pay, I have a friend who tenants just in a house stopped paying, and it took him almost 5-6 months to get them out. And so versus in some of these other states, somebody stops paying, get them out very quickly. So it's just the ability to do what you'd like with your property, the absence of rent control. Which actually rent control makes housing more expensive for everybody in that area because it reduces the supply. So there used to be kind of this. I run a meetup in Pasadena where I live. We had about 70 people there last night, and this came up well, isn't there this 2-hour rule? You've got to live within 2 hours of the real estate you own so that you can go there if something goes wrong. Well, I live a 5-6 hour flight from where my real estate is, right? But then what it does is when you set it up that way, it really means that you have to develop a team, right? So I've got partners actually live in Florida that actually are there on site. We've got a full-time asset manager. So we've got teams of people. So how I set it up is I'm not the one who's getting the calls and trying to manage all that from day to day. We've got team members that do that. So the numbers make a lot more sense. I have a friend that says, live where you want and invest where the numbers make sense, right? And so the returns are just 2 to 3 times higher in a place like the Sun Belt because of the growth, population growth, job growth, income growth, and you just get a much higher return.
So we started the show today with the inflation and the recession, and we're not sure when we're gonna hit the bottom yet. But one of the things with the underwriting now is the high expenses from the maintenances, insurance, the payrolls. So right now we're seeing a lot of slowdown, especially on the fourth quarter and third quarter on deals in general because of the high expectation of the seller so far not yet meeting with the buyer perspective or underwriting, how you see the first quarter so far on Florida, for an example, or Atlanta?
Yeah, so I think, you're talking about the first quarter and the first quarter of this year in Florida,
Yeah.
you're asking about specifically.
Yeah.
So I think, when you buy in areas where you're seeing population growing, it gives you, Warren Buffett, I follow him a lot, but he talks about the idea of a margin of safety, right? So a margin of safety is if things don't go exactly the way you expect, you still have some protection there. So one protection is being in an area where there's continuing growth. And we feel like that is only going to continue because of baby boomers moving to Florida. It's much more affordable than like living in Miami or living in Orlando or something, living in a place like Jacksonville. So secondary market can be good. Another margin of safety we like, this is a little bit of a side note, but when you're buying an area that's growing, if you have a value add component, right? So if you're buying REITs or you're buying a brand, everybody's like, isn't a syndication, a passive investing deal like what we do, isn't that similar to like a REIT? And I say, well, no, it's very different because a REIT is publicly traded, but these REITs, they have so much money. They have billions and billions of dollars. They have to go into the biggest areas, buy the newest properties. And so they really own the real estate market. So they're much more dependent on, if real estate goes up, it'll go up. If real estate goes down, it'll go down. And so that's, kind of how they operate. When you have a value add component, like what we have is we're buying stuff that's built in the 70s. We like to go do a renovation, spend $6,000 per unit. We know if rent's $1,000, rent can go to $1,500, which is like a 50% upside, which will increase the value by about 50%. Because that's how, commercial real estate is different than single family. It's not based on comps, it's based on income. So that puts a big margin of safety in there, no matter what happens to, in valuations or what happens to, what interest rates or things like that. So that's kind of what we like. But I think in general, we love, this part of Florida in particular, because we still feel like we're able to find great deals. Right now, it's a little hard to get deals across the finish line just because of lending, because rates are higher, as well as instead of putting 20% down, you have to put sometimes 30, 40% down. So we like the deals we're in. We feel very comfortable with them. We're continuing to keep our eyes open. We know that's going to probably, the tide is going to turn at some point, hopefully in the near future. It'll give us a chance to really jump in with both feet and continue to add more.
Regarding your portfolio and especially on the Sunbelt, I saw like an actual trend in all of the active syndicators trying to avoid the C class, especially on Texas, because of the insurance and the high maintenance fees. What is actual sweet spot for your portfolio right now? Is it B or C or A class?
So we do really, I would say B and C class. We're kind of going the C plus, B minus stuff. A lot of times, I see ads out there for passive investments, for syndications, and it shows this beautiful brand new building with a pool and a sauna and all these amenities. And I always tell people, well, you're not personally going to be living there, right? So there's kind of the sweet spot I find. Class A, again, there's not as much value to add. Class D is kind of the lowest, roughest property, gang infested, whatever. It's very difficult to change a D property, particularly if it's in a D area. It's just very difficult. But C and B and C is really workforce housing. It's working class apartments. There's a lot of need for that. Typically, you have pretty good tenants. If you can change a property from a C plus to a B minus or a B, you can bring in a different type of tenant, and you can really increase the value pretty dramatically. We've done that. We had some good exits where we've really been able to successfully do that.
Regarding the actual assets and the current market now, especially with the underwriting, how you see the actual market flow with the deals right now with the prices, especially that we gonna have potential opportunities and distressed properties because of what happened in the last 2 years with the floating rate on 19 and 20s, when some of the syndicators have to give up and sell anyway. So how you see right now the actual market flow of deals?
Yeah, Adam, I can tell you're in the multifamily world too. Here looking at the stuff we're looking at there's going to be some distress that comes up. There's going to be people, we're already seeing it. I've seen some deals where people did really a deep value add kind of at the wrong time. Their interest and their financing costs have gone way up, and they're in trouble, right? Because they're not, these deals, they assume they were going to be able to turn around. They're not able to turn around because their costs have gone way up on the financing. So I think in general, there's a difference between right now going after new properties. If somebody did get in over their head, or there's not a value add that's there, I really think a lot of stuff is at risk, particularly some of the newer stuff that some of these big REITs had. There was actually a couple weeks ago, there was a couple articles that came out. There was a big group in San Francisco that has like 50 properties worth over 500 million, and they're in delinquency, or they're basically going to be defaulting on it. There's another one, I think it was New York or somewhere else, that was about 400 or 500 million. So there are groups out there now that are are in trouble. And I think, Warren Buffett also has a saying, again, another Warren Buffett saying, kind of the idea, be fearful when others are greedy and be greedy when others are fearful. So a lot of people right now are very fearful. A lot of people, there's a record amount of money in Americans' bank accounts. It's actually about 4 times what it was during COVID, which was the highest we ever had. It's about $5 trillion now. So a lot of people are just waiting. But the problem with that is inflation is high. You're going to get hurt by inflation just by keeping money in the bank. So I think it's really important to have other investments you do, or just really keep an eye. Okay, what should I be doing here? So we feel good about the deals we have because of the value add component. We're also going to continue to watch and see, as distress, stuff becomes available, there creates some really unique opportunities. So I think really what gives you safety is a value add component, is being very conservative on your underwriting, and also having either you have fixed rate debt, which can be challenging to get just to make the numbers work, or you have bridge debt with some sort of cap on it. And of course, the interest cap, where you limit the insurance on the cap, the interest cap there can be kind of expensive. So those have gone up sometimes 20 times as much as they were a year ago. So that's very significant. But, it is something to really look at. And it's something that we're watching in our deals. It's something we're watching in other people's deals. We want to make sure that we're positioned to take advantage when the time's right.
Going to your deals and your brand, going back 5 years back, building your brand, building podcast. Tell me about the podcast you have, building, because we're talking about team sport here. You have to have to raise capital. You have to have an image. What was the beginning for you when you decide to have a podcast?
Yeah, so for me, I started the podcast. We've been doing deals for a while, and then I started the podcast about 1.5 years ago. So I've been, about 2.5 years in. I decided to start the podcast. I just, wanted to create a place to have conversations like this show that you're doing, where you can have high-level conversations. Our show is dedicated to passive investing. So people that are, busy professionals, business owners, people that are trying to reduce taxes, all of that. We have a show called the Mailbox Money Show, and so that's been a lot of fun. But yeah, no, I think, the reason I do that, and I have my YouTube channel and we have other things that we're doing, is we're just trying to create value in the marketplace. A lot of people are just really concerned. They don't know what to do right now. And yet there's incredible opportunities to make money right now. It's just, you have to know how to position yourself so that you can take advantage of it.
Bringing to the subject of the passive investing and your show, what is your actual advice to passive investor right now? Is like comparing between the REIT and syndication or fund model?
Yeah, so I think right now, I think it's important. We're diversifying, outside of real estate right now as well. We have our ATM machine fund. We're partnered with the 5th largest operator of ATM machines in the country. We open this fund a few times a year. We've raised quite a bit of money for this. And so, we like it. It's the most consistent cash flowing deal that I've seen. So that's something that is very unique, has some tax benefits also. We also just this week, at least the time of this recording, we opened our car wash deal with a private equity car wash group. And we're pretty excited about that. So finding things that, are recession resistant, that have lesser or no leverage, is really a positive. In any deal, there's always risk in every deal. So I always tell passive investors, try to figure out what could go wrong in this deal. What are some of the risks here? And then how likely is that scenario? And are you comfortable with that? Or what, if it goes well, what do you make? And if it goes not well, what do you lose all your money? Do you lose temper? Like what are kind of the likely scenarios? So I think right now, again, like I mentioned, we're positioning ourselves to be ready for opportunity in multifamily. We're also branching out and doing some other alternative assets also.
You mentioned something about private equity, and my question here, what was the motivation now here is instead of raising capital from the accredited investor to go to the private equity as a stack equity on your deals? And what was your advice to active syndicators who are starting their negotiation with family offices and private equity firms?
So your question is more about asking about bigger institutional firms going to get capital from larger firms. So we don't really do as much of that, just because we found, we have several investors that invested over $1 million the last year, but it's mostly just wealthy individuals, retail investors. There are people we know. We have a lot of friends that, have a number of friends that work a lot with family office or bigger institutional groups. I've just found, for a lot of people, they are busy, they're professionals, they're trying to figure out how to get started in it. That's kind of the person I've really focused on. And then, eventually we might start working more with institutional folks. It's just sometimes because they're writing a big check, they can try to squeeze you and say, hey, we really want all this, and kind of change the terms and really try to squeeze you a bit as an operator. to where it just, the terms are more favorable for them and less for everybody. So, it's not that we're not open to it. We're definitely open to it. It's just we've traditionally done more, of the 30 million we've raised, we've done just mostly retail investors.
After raising 30 million, how you can describe your superpower?
Well, I think, when I first started, I thought, I know I want to get into multifamily. I wasn't sure. Usually there's two ways people get started in this business. Either it's raising money or it's finding deals. And I thought I was going to be a deal finder. So I analyzed 50 or 100 deals, and I was bringing deals to, a larger group and say, hey, here's a deal, whatever. And then I realized, like, man, I have 10 years of sales experience. Maybe this could work raising money. And so I think for me, I think for me, it's really connecting with people and really trying to create value from conversations, whether it's me talking or we do a panel, just really trying to help people understand finance. And I think that's really my passion is, I think when someone's financially free, it frees them up to write the book they want to write, or spend more time with family, or to not work because they have to. It's something like 65% of people hate their jobs, right? So if we can help people become out of a place where they don't, they're doing something they enjoy, or they have freedom to, well, if you had all the money, would you quit your job and go teach high school math or something? Or would you do something totally different that's more in line with really your values, rather than letting money trying to drive that equation?
And before we conclude, how the people can reach you?
Yeah, so this is awesome, Adam. I appreciate you having me on. So this is the ebook I wrote. It's called How to Use Inflation to Your Advantage. It's 50 color pages on my website at bronsonequity.com. We also, if people want to join our investment club, we have some of these unique deals there. That's at Bronson Equity also. I'm also on social media, and I love connecting with folks about investing. So thanks for having me, Adam.
Great stuff, and hope we can bring you again to the show.
Awesome. Thanks so much.
Thank you most.